like Bloomberg.
23 seconds away from the opening bell this morning. Good morning. This Monday morning, your equity market down just 0.1% on S&P 500 futures, which is precisely where this market was through last week, down just 0.1% and going absolutely nowhere on the S&P. Hasn't felt like a snooze, it's just looked like a snooze. That's the opening bell. Switch on the board and get to the bond market. Anything but a snooze in the Treasury market over the last couple of months. Yields on a 10-year 353, down about 4 basis points, in and around 350. Kind of stabilised around that level on a 10-year maturity. On a 2-year, through the whole of last week, Monday through Friday, the 2-year yield above 4%. And again this morning, even with yields coming in a couple of basis points, your 2-year 416. Euro dollar back through 110, 110.18. The euro against the dollar positive a third of 1%. And crude south of 80, $77 and about 60 cents. We're down about a third of 1% on the session. About 30 seconds into this session, we look like this on the S&P. On the S&P, we are totally unchanged. On the Nasdaq, we're down by around about a tenth of 1%. One stock to watch at the open is Bed Bath & Beyond. Shares plunging after a bankruptcy filing put an end to the retailer's last-ditch efforts. The company wrote in an email the following: our stores are open and serving customers. However, we have initiated a process to wind down operations. Abby has more. Hey, Abby.
Well, John, this is really pretty amazing. And of course, this possibility of bankruptcy, what is reality now? They did, of course, file for Chapter 11 bankruptcy yesterday. It's been speculated upon, and here it is. It has happened. The company simply collapsing under years ago, making the choice to put way too much merchandise, it seems now, and even seemed then, into their stores. Then you couple that with e-commerce and then the pandemic. That was really the nail in the coffin. Now, they will be winding down by June 30th. They are looking for a buyer. They will be liquidating nearly 500 stores. That includes the Bye Bye Baby stores. And of course, those iconic coupons, which, John, I'm guessing you don't use, but I still have some of them in my car right now. You can't use them after April 26th. So this is really the end of an era here. As for the investors, if we take a look at the chart, this is really pretty amazing, because just 2 years ago in Meme Mania, this was a $53 stock. It is now a 21-cent stock from the peak, the real peak, down even more. But anyway you slice and dice it, basically wiping out all of its market cap. A case study probably for generations to come of B-school students, what not to do here for Bed Bath & Beyond, again, filing for bankruptcy.
Always sad when this stuff happens. Abby, thank you. Lots of response on the south side. This from Piper Sandler, expecting a number of retailers to benefit from the bankruptcy over at Bed Bath & Beyond, saying this: Bed Bath & Beyond has been a multi-year share donor and leaves $6.2 billion in sales up for grabs. We believe we're entering a new phase of retail industry consolidation, with Target and Walmart being the long-term beneficiaries. Again, Bed Bath & Beyond down by 29%. Also looking at Tesla, raising its capex forecast for 23 to as much as $9 billion. That's $1 billion more the company projected back in January. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. We're down by a percentage point at Tesla following the open. Not as deep a decline as we saw in the pre-market when that regulatory filing first hit. As you said, a minimum of $7 billion, a maximum of $9 billion. At both ends of the range, that is a $1 billion boost. And actually, it's something that Tesla did a number of times between mid-2022 and present, boosting the capex forecast at a time where they're cutting prices on EVs here in North America. They did recently just re-raise prices on Model S and Model X, and internally a view on cutting costs is a big focus. But reminder of Elon Musk's commitment to sustaining growth at the expense of margin and profit. That's something that he's been relatively clear on, and while the sell side at least are a little concerned about the impact of price cuts to product on that bottom line, at least Tesla is consistent on the view of investing through periods like this to maintain that growth rate.
The stock is down about 1%. Not a big move for that name, all things considered. Ed, thanks for that, mate. Thanks for the update. I want to turn to earnings. Dan Skelly of Morgan Stanley alluded to this one. Coca-Cola successfully raising prices and delivering strong revenue growth. The CEO doubling down on the year ahead, writing this: we're confident in our ability to deliver on our 2023 objectives. Katie Greifeld joins us with more. Hey, Katie.
Hey, John. Yeah, people are buying soda, and Coca-Cola expects that people are going to continue buying soda. You can see that the shares are up about 1.3% right now. And if there's a takeaway, you spelled it out really nicely. It's that Coca-Cola still very much has pricing power here. We learned that customers, they're willing to pay up for Coke products at live events, and that's helping to offset some of the company's still high input costs. So you add that together, and all told, Coca-Cola beat on adjusted EPS and on organic revenue. Adjusted EPS came in at 68 cents, 3 cents higher than the average analyst estimate. And in organic revenue, it grew by 12% in the quarter. That's versus the average analyst estimate of about 9.6%. Even still, Coca-Cola maintained its full-year revenue forecast in a range of 7 to 8%, John.
Thank you, Katie. Thanks for that. Just distracted by getting a little bit more information about what's happening with the debt ceiling debate. I want to get you the update with Emily Wilkins. Morning, Emily.
Morning, John. So obviously the debt ceiling debate, Republicans face a critical test this week. Can they actually pass their own plan of what they would cut to then raise the debt limit? At this point, it's not really clear that that's something that they're going to happen. McCarthy, of course, is confident, saying he will be bringing the bill to the floor this week. But you have some moderate members who have concerns. You have some hardline Republican members who have concerns about work requirements and the amount that folks will need to actually work per week to get federal benefits. And it's not clear that how leadership is exactly going to be addressing some of those concerns and whether or not they'll be able to get all Republicans on their side. Of course, the key here, the key goal for McCarthy is to make sure that he's putting pressure on President Biden to get back to the table and to negotiate with him and the Republicans. He knows that whatever bill passes this week is not going to be the final bill. We still have plenty of negotiation to do before we actually get to that X date and figure out whether or not, or what it looks like rather, to raise the debt limit.
Emily, thanks for that. Let's get to Mike Schumacher of Wells Fargo for the latest on this. Mike, I've been looking forward to having this conversation with you. It feels like slowly the T-bill market is now starting to price some of this tension in. Can you walk me through what you're seeing at the moment, Mike?
Yeah, John, it's been really interesting. If you think about the last week, tax date was the 18th, and at that point, people became super concerned about the debt ceiling. It had never gone away, but it was out of focus, I think, a bit with all the bank troubles. And now we look at the T-bill market telling us is you've got just an enormous difference in bill yields. There's a huge aversion to June, July, and August bills. Let me give you some numbers. So May 30th Treasury bill yield is, call it 360, something like that. June 6th T-bill, so just a week later, 470, 475, 100 basis points plus premium, if you will, to avoid June. Now it goes up a little bit from there, but people are saying, don't give me that June stuff. I don't want July. I don't want August. I want to stay out of trouble.
Mike, if that tension continues to build, do you see it isolated in that part of the T-bill curve, or do you see it spilling out somewhere into the Treasury market in a way that's currently unanticipated?
Yeah, we think it spills much more broadly, John, and it's very interesting. I think Emily's point was very telling. Can the Republicans pass a bill? We don't know, and that's why people are so concerned about the debt ceiling. So if there's a lot more discussion, if this bill doesn't go through this week, I suspect you're going to see Treasury yields come down dramatically across the spectrum. So 2-year down a bunch, 10-year down 25, who knows, maybe 50 basis points if things really go off the tracks. But across the curve, it's a risk-off event in our view.
Mike, a risk-off event I think we can all agree on. It's Treasury yields going lower that you're getting some pushback on. Mike, there are some people who believe that maybe it's different this time around, that you don't run two Treasuries, you run away from them. What's your greatest pushback against that argument at the moment?
Yeah, it's pretty tough to buy that one, John. When you think about risk-off events globally, people say, oh, gee, I'd love to avoid the U.S. dollar. I'd like to put my money somewhere else. Well, that all sounds good, but where would that be? So if you've got lots of dollars to deploy, lots of risk to deploy in general, the U.S. markets are so deep, so liquid, people can't just go running over to the bond market. The Treasury market is 10 times as big as the bond market. Can't go to the gilt market. Canadian government bond market, I don't think so. Japanese government bond market, 90% plus owned by domestics and a huge portion owned by the BOJ. So there simply is no other good spot to go. If people want to shift risk out of, take your pick, equities, credit, what have you, they really need to go into U.S. assets. So I think that's the best counter-argument.
So Mike, do you think that politicians in Washington have the luxury of falling around on this topic?
I think it's a bit of a game of chicken, John. So you've got President Biden, Speaker McCarthy, Chuck Schumer, et cetera, all kind of looking at each other and saying, well, how close do we dare get? And our concern is that perhaps they get just a little bit too close to the edge and markets get super concerned. So there's enough latitude now, enough time, I would say, to recover. And get a deal done. But the big issue in the markets is as April ticks into May and as we get toward late May, I think people get very, very concerned.
Mike, we're starting to see volatility between the bond market and what's happening in the equity market almost diverge. I'm looking at what's happening with rates volatility, and it's still elevated, and equity volatility, the VIX, so to speak, has come back down. Mike, what do you make of what's happening there?
Yeah, it's sort of a telling sign, John, when you've got really a very high delivered volatility in the bond market. Now, a bit less over the last week or so, but just enormous delivered vol for weeks. Less delivered volatility in the equity market. So thinking about markets like options traders, if the 10-year Treasury yield's moving 10, 15 basis points per day, they can rationalize having implied vols very high. Equities simply have not produced that level of volatility. There's more of a wall of cash staying in the stock market right now, is my take.
Mike, we're going to continue this conversation around the Federal Reserve. Can't believe we talked about the bond market for about 5-6 minutes without discussing the Federal Reserve. Mike Schumacher of Wells Fargo will stick with us. The broader market right now, about 10 minutes into the session, we are positive by 0.1% on the S&P. On the Nasdaq, we are positive by 0.1%. Also, the Russell just a little softer, negative. Coming up on this program, all eyes on the data as the Fed goes dark.
If data show continued strength in the economy and slower disinflation, we may have more work to do.
That conversation up next.
This data-dependent risk management framework has led me to support the FOMC's response of rapid monetary policy tightening. If tighter financing conditions are a significant headwind on the economy, the appropriate path of the federal funds rate may be lower than it would be in their absence. But if data show continued strength in the economy and slower disinflation, we may have more work to do.
It's a busy week of economic data as the Fed goes quiet ahead of next week's rate decision. Investors looking ahead to another round of jobless claims, US GDP, PCE and PMIs all on deck. Katie Lyons has more. Hey, Katie.
Yeah, John, it's a lot for the Fed to parse through when it makes its decision next week, but arguably Friday's data may ultimately be the most important because that is when we get PCE deflator as well as the employment cost index, so the Fed's preferred gauges of prices and wage pressure. It is the inflationary read that remains critical as the market expects because of ongoing inflationary pressures. The Fed is going to hike 25 basis points next week. That, though, is seen as likely the last hike of this cycle. Yes, the market thinks we have more than 25 basis points to go to get to terminal, but they don't expect that we will stay there for very long because right now pricing indicates that this Fed is going to turn around and start cutting rates by the end of this year to the tune of more than 50 basis points. This is where the other economic data comes in. Do we start to see further cracks and weakness forming and signal a softening economy that would support the case of more dovish members of the committee like Austin Goolsbee, or do they support more hawkish members like Jim Bullard who think the banking system and economy are resilient enough to take additional rate hikes even beyond May? To put it in the words of Anna Wong over at Bloomberg Economics, there's more disagreement among committee members than meets the eye. And that level of uncertainty around the economic and Federal Reserve policy is what has led to elevated volatility in the bond market. Yes, the MOVE index has come off of its highs of the year, but still we are quite high relative to history, John.
Katie Lyons, thanks for that. Appreciate it. And I couldn't agree more. There is a big divergence within the Federal Reserve that we don't talk about enough because we often talk about the median dot in the so-called dot plot and plot that against market pricing for rate cuts so far this year. If you go into the SEP, and we've talked about that a few times on this program, that's a summary of economic projections for, say, 2024. The range on rates for 2024 on the FOMC is anywhere from 3.4% to 5.6%. That's the range, from 3.4 to 5.6. Mike Schumacher back with us from Wells Fargo for more. Mike, do you think we make too much about that so-called difference between what the market is pricing, and I'll come back to that in a moment, and what the Federal Reserve is projecting?
I actually like your point on the range, John. I think that's the key one here. When you consider a turning point in policy, whether it's the Fed or any other institution, that's when people tend to disagree. It's very difficult to call the exactly appropriate time to switch from tighter policy to standing pat to easier policy. I think that's a natural time for disagreements to manifest, and that, at least is, in my view, why you've got such an enormous range for next year and why the market struggles to price it.
I think we're struggling to price in. That's the point, Mike. We often talk about the bond market, the rates market, pricing in rate cuts. And Mike, I've had a couple of guests over the last week or so, Gershon Distenfeld of AllianceBernstein, Ed Al-Husseini a little bit earlier this morning, pointing out to be careful here, that this is about a weighted average of two different scenarios, the probability of one occurring and maybe not the other. Either we don't need rate cuts at all, or we need tons of rate cuts. Now, Mike, are we at this situation right now where we all talk about how much is priced into the bond market, but ultimately it's either too much or not enough?
I agree with that scenario, and basically it all goes back to the Fed leaving that punch bowl at the party way too long, and now you've got a bunch of people staggering around, and it's got to say, well, okay, we've got call it a moderate probability of a very large cut. Maybe it's 200 basis points over the next 12 months or so, or a pretty hefty probability of no move. And the market weights this, of course, and it winds up with, oh, well, if you look from, let's say, the peak this year to the ending point of 2023, it's 55 or 60 basis points. I think it's really inaccurate to consider that to be, call it 25 basis point cuts. It's much more the case. Something goes badly wrong. The Fed reacts by going 100 basis points or perhaps more in a meeting or two, and boom, you've got a very different scenario. So the market struggles to try to assign these, call it moderate to smallish probabilities. I think it's a natural course, and I agree with Gershon and your other guests that that's the way you've got to think about that right now.
Mike, with that in mind, is it easier to think about how the longer end might develop relative to, say, the 2-year spot and into the belly of the curve?
think it probably is, John, and we've had this discussion with a lot of clients. People will say, well, hey, you've got this big inverted curve right now between the 2-year and the 10-year Treasury or the 30-year, whatever you like to focus on. Why is that? Very different investors active on the front and the back ends, as much as I've seen that divergence in many, many years. So when we think about the long-end investors, how does their calculus change? What do they look at? Well, for pensions, for instance, they focus on the relative performance of equities versus bonds. For life insurers, it tends to be more tied to absolute yield levels. These things are not as directly impacted by Fed policy as the 2 or the 3-year Treasury. So I think you're right. It's much easier to focus in this particular context on long-term rates. Now, our view is that we're bullish for the next, call it, month or 2 or perhaps 3 while the debt ceiling drama plays out. After that, I suspect a bit more bearish, but a lot more variability in our call, and I think the market's call for the front end. For the back end, it's a much more stable environment in our view.
So, Mike, just to be clear, that call on the 10-year, that's a tactical call? It's a short-term call around the debt ceiling debate?
That's exactly right, John. It's event-driven, and event-driven calls are tough. It's not a function of core CPI goes to X, we change our call, or core PCE does whatever it might do on Friday. It's not like that. It's very much tactical, very much driven by the debt ceiling per se.
As you take a longer-term view then, Mike, of the bond market at the long end and start to think about things like inflation, I'd return back to that piece that came out from the IMF a couple of weeks ago talking about a return to pre-pandemic interest rates. Do you see it quite the same way?
No, definitely not. When you think about the IMF's view, it's taken a very, very long-term view. For us, we look at it and say, what are the motivations of the central bankers? What do they care about? They care about real yields. Real yields on the U.S. long end, in our view right now, are too low. Now, set aside the next month or 2 or whatever it might be until the debt ceiling is done. But beyond that, when you think about a real yield of a 10-year Treasury of 110, 120 basis points, that's really not going to get the job done. So we think real yields need to go up. Now, some of this happens as inflation comes down, but also probably nominal yields have to go up in time, too, to make that occur. So to push reals up to 150 and keep them there for a while, that's more of a long-term bear call. But again, we have to get through the next few months until we make that happen.
Interesting. Thanks for the clarity on that, Mike. Appreciate it. Mike Schumacher there of Wells Fargo on this bond market, making that short-term, event-driven call around the debt ceiling debate for lower interest rates, lower yields, so to speak, on a 10-year, but ultimately, over the long term, elevated real yields. Right now, nominal yields down about 3 basis points on a 2-year at 4.15%, on a 10-year, down about 4 basis points there to 3.53. That's the bond market taken care of. The broader equity market about 22 minutes into the session, positive by 0.1% on the S&P 500, on the Nasdaq up by 0.1% there. Big week for the Nasdaq 100. Talked about those tech earnings. I'll go back through the calendar again for you. Tomorrow, Google and Microsoft. Wednesday, Meta. Thursday, Amazon. On to next week, we'll hear from Apple. Next Thursday, I believe, May 4th. That's the same day as the ECB decision. May 3rd, the Federal Reserve. And then on to payrolls on Friday. So this week, next week, it's going to be a big couple of weeks. Let's get you some sector price action. Here's Abby.
Well, John, with the S&P 500 barely moving higher on the morning, not surprisingly, the sectors beneath not moving all that much either. The best sector is consumer discretionary, really being helped out by Amazon ahead of that big report. Services, communication services after it. Interestingly, real estate and utilities down, even with yields lower. Typically, those dividends would look more attractive. Let's weigh back in, though, on this week's big tech earnings, and that, of course, is with the year-to-date moves. It's really stunning. $16 trillion worth of market cap reporting this week, and among this year's best sectors, discretionary, tech, and consumer discretionary, all up more than 15%. The worst sector on the year, financials, down just 3%, though, at this point, John.
Abby, thank you. Looking ahead to First Republic a little bit later after the close. Up next, your trading diary, live from New York. This is Bloomberg. 25 minutes into the session, we are just about positive on the S&P 500, up by 0.2%. A little more than 40% of the market cap on the S&P 500 reporting this week, thanks to Stuart Kaiser of Citi for that stat. Busy week of earnings, particularly for big tech. Mega cap tech just around the corner. The Nasdaq positive by 0.2%. That's the equity story. In the bond market, yields come in just a little bit, down 3 on a 2-year, 4.15 on a 10-year, down 4 to about 3.53, in and around 3.50. More broadly over the last week or so, finding a bit of stability there, for now at least. That's the price action. Let's get to the trading diary. First Republic after the closing bell later this afternoon. Alphabet, Microsoft, those earnings on Tuesday. Meta on Wednesday, followed by Amazon and Intel on Thursday, plus Q1 GDP and another round of jobless claims. And finally, rounding out the week with PCE, UMich Consumer Sentiment Survey and personal income numbers. And that rounds out the morning for me. Looking forward to covering a busy week with you all. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Monday, April 24th. Here are the top market stories that we're following for you at this hour. All right, place your short bets. Hedge funds ramp up short positions on the 10-year treasuries to a record. Equities hold up despite pessimism. And Elon Musk opens his wallet. Tesla increases CapEx $9 billion on the high end while trying to manage price cuts as well. That stock is down by about 0.5%. And earnings bonanza. 178 companies in the S&P report this week, from retail to tech. We're going to look for the pain trade. Those are a lot of companies. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, a real pleasure to get you back. We were talking about kind of what you missed last week. It feels like this is the week that you want to make sure you're in your seat because there's a lot to go down in terms of numbers.
We are ultimately in the volatility business, and I kept checking last week and there didn't seem to be much. Yes, we saw a little bit of a sell-off in the bond market, but I was getting to the point by the end of the week that I was pretty certain that the equity market had gone on holiday as well. No volatility last week. Must have been a tough week for you guys.
Yeah, it really was. But did you really check your email? Let us be 100% honest about this.
I didn't check, but
your
email a little
says
less.
Otherwise.
A little bit, a little less. Yeah, definitely. No, I was checking the news.
Okay.
Just, you got to keep up to date. Not that much, but you just want to stay a little bit current. Otherwise, the Monday morning after the holiday is always a tough one. But I didn't miss much by the looks of things.
No, you really didn't.
So when does the volatility show up? To your point, Alex, yeah, I think John was making this point a moment ago. I think 40% of the S&P reports this week. It's a huge week. So maybe this is finally the week when actually that volatility shows up. Is it going to be that week, or do we have to wait until May? Like, do you sell in May and go away? Is that the trade? So what is the pain trade this week, other than me being back in the office? That's just a personal interpretation of what the pain trade is going to look like this week. I think that's a key question. I don't know. What do you think the pain trade looks like? Everybody's short, Alex. You short the bond market, you short the equity market. Does that mean that the pain trade is for things to go up?
Yes. Sorry, thought you were going to bring the guest in, but you didn't. That's okay.
No, I probably should have done. I'm rusty. I've had a week off. Edward Harrison, Liz McCormick, join us now to try and answer that question. Liz, we're short the bond market. Certainly the discretionary funds, the leverage funds are short the bond market. Therefore, I'm assuming the pain trade is the other way.
Yeah, but it's complicated, right? Because like you said, the hedge funds, the leverage folks are leaning really hard, record shorts. But you got asset managers who keep buying, right? They're long, so they keep thinking, oh, it's a good coupon. So I feel like there's a lot of pain to be had all around. For sure, if rates kind of tumble downward, those hedge funds that are short are going to be clipped again. And they had pain before, and they'll get it again. But, on the other side, you've got a bunch of longs. So I think there's a lot of pain on a lot of different angles. But, on the hedge funds, they're definitely short, for sure.
So, Edward, then how does that go to the equity market? It's the same kind of setup here, right? It's like we had a lot of pessimism going into earnings. It's not that hard to then beat. And then you don't see a lot of action in the equity market.
Yeah, I mean, the pain trade is definitely, I think, higher in the equity markets. That's because everyone's short. So if everyone's short, if we have 40% of the earnings coming out this week right now, massive number of companies that are reporting. If they report better than expected in general, even though equities are priced very highly, the price earnings ratio is very high, still you can grind higher. And I think that the fact that the volatility is low is because everyone's positioned on one side of the bet. And so therefore I think that that's where the pain trade is, that slow grind higher.
Well, let's just talk about positioning and how people's perception of this earnings season is shaking out. The bar has been lowered really quite significantly in terms of what this earnings season is set to deliver. Therefore, with such a low level of expectations coming in here, shouldn't the expectation be that we're going to beat? Why is everybody short when expectations for earnings have been lowered so much?
Yeah, I think it's because they're expecting sort of like the second shoe to drop. Because when you think Q4 of 2022 was we had negative earnings year over year. Now EPS this quarter is expected to be negative year over year. That's two back to back on the back of potentially a recession as we're going into a potential credit crunch. So everyone's saying that, okay, so it's going to get much worse from here, and they're positioning for that trade. And as a result, everyone's on one side of the trade, and therefore you don't get a lot of oomph out of that unless it actually happens.
Liz, can we go to the other macro risk this week? So we get a lot of micro in terms of earnings, but then we have the BOJ on Thursday. We have GDP. We have personal spending here in the U.S. There's also this China risk that keeps bubbling up. There's a stress in the debt ceiling. Like, how is that then affecting what traders are doing within the bond market?
Yeah, and I think that's why there's so much rates volatility. While Ed's saying there's not too much equity vol, there's a lot of rates vol because you're right. The BOJ, there's a mixed view. Some say they maybe wait another month until they maybe change the yield curve control, but they do like to surprise. So there's that risk. And the debt ceiling is getting, worse and worse with McCarthy has the bill, which he may not have the votes. Even if he does, it may not go through. And, Goldman Sachs just moved forward their so-called X date when Treasury will just run out of money using extraordinary measures to like June. So there's just so much risk. You see that in the credit default swaps pricing going up on U.S., which, you don't think the U.S. will default, but people are taking a spec on that. What if they do? So I just think in the bond market, there's so much risk, you can't just kind of siphon out vol yet. It's just remaining high.
Liz, is all this risk sort of cancelling each other out? All these risks cancelling each other out? There just seems to be so much going on at the moment, yet everybody seems to be a little like a deer in the headlights, trying to figure out exactly where we're going. The degree of certainty seems to be quite low.
Well, exactly, and that's why cash is looking pretty good, right, for a while now. And you could say, somebody said to me, a macro fund manager, like, I'm getting paid to wait, basically. Just to your point, he was very uncertain, but look at the short end. You maybe get 5% on some things, that are, high quality short end. Even bills, or treasury bills, are very attractive. So that's what you have a lot of people, and money market funds have gotten a big swath of money since the banking crisis. So even on the retail end, people are saying, hey, it's pretty good. I'm getting a decent amount of money. It's tricky though, because you keep looking at the stock market and it keeps going back up, even though everyone says it should go down. People are starting to wonder, oh, am I missing? Should I? It's very tough.
Right. It's like everyone hates stocks and loves bonds, but then stocks hold up. Edward, makes sense of that for me. Why aren't we seeing the selling of the stocks to buy the bonds?
I really think that since people are waiting for the second shoe to drop, really what's going on is that when it does happen, that's when we'll get the volatility in the equity market. And in some ways, you could say that bonds, I would go on the other side of that, because bonds are pricing in 3 rate cuts that may not happen. We see USD, JPY, we see the DXY, all of the US dollar comparisons as very negative. Because people think that the Fed's going to be easing, but maybe they won't. And at the same time, we have this whole shoe to drop in equities. So I think that we're really waiting, we're being paid to wait patiently until the event happens. And when the event does happen, I think there'll be a lot of volatility associated with that.
And the event, we're just waiting for the event where we price out rate cuts. I just still don't understand what that's going to be. Guys, thanks a lot. Great way to set up on this Monday. Edward Harrison, Liz McCormick, thank you both very much. So coming up, question of the day with Gargi Chowdhury, a BlackRock head of iShares Investment Strategy Americas. What's the pain trade this week? This is Bloomberg.
buying season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The outline speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We continue to believe at Federated Hermes that we're going to be caught in a wide range that we're at the high end of right now, and probably for maybe another 9 to 12 months. We're looking at a 1% GDP this year and next. I've been thinking of a fun word to describe this is slowflation, slow growth, and inflation that's still going to be more stubborn than you would have liked. Tough to be a bull and tough to be a bear.
That was Linda Dussel, Federated Hermes senior equity strategist on Bloomberg TV earlier. So I want to bring in a question of the day. What is the pain trade this week? Joining us now is Gargi Chaudhry, BlackRock head of iShares Investment Strategy Americas. Gargi, great to get your perspective. Where's my pain trade? What is it?
So this week, given all of the earnings which you guys have been talking about that we're going to get, it feels like the pain trade will actually be a continuation of the rally that we've seen this month, this year. And I would imagine, particularly, it's been an unloved rally in the tech sector, right? Everyone's been calling for a little bit of a pullback, and we haven't seen that. So again, this is not the base case, but certainly a continuation of the rally where even if companies miss, that equities rally or certain sectors rally based on forward guidance, based on cost-cutting measures, based on margins, I would imagine that is the pain trade for the week. And I would also add that, we obviously spoke about earnings, but I think the same could happen in the bond markets as well. People have hated the rally in the bond markets as well. I actually think a rally in the bond market makes a lot more sense than a rally in the equity market, but we could certainly see this 350 level break and that be a pain trade as well, break to the downside.
Gargi, everybody hates all of these markets. They're really tough to trade. Great to see you, by the way. I read your note this morning. The words that stood out to me were opportunistic, nimble, tactical. Are these markets, given what you've just described, that you can invest in, or can you only trade them?
Good morning, good afternoon, Guy. Great to see you too. I'd say that, yeah, you can certainly trade them. You can invest in them. I also think that being nimble and using tools that allow you access and liquidity in the markets like ETFs are really critical at this juncture. I mean, just think of this year so far. We've had 4 regimes in the first 4 months of the year. We had that risk-on rally. We had that sell-off. We had the credit crisis in March. And now we have a little bit of a low vol environment in April. I think you need to be able to move in and out. I mean, if we price in 4 rate cuts again, you're supposed to leave the bond market. If we get towards 3.75 to 4% on the 10-year treasury, you're supposed to allocate to the ag again. So I think being nimble till we figure out exactly what is going on with growth, till we figure out exactly what the Fed is going to do for the remainder of the year is really crucial.
That's the really confusing thing. So for on earnings calls, is that everyone sounds pessimistic, but nothing is actually delivered yet in the numbers. So what are we waiting for? Like, this is the pain trade you were talking about.
Yeah.
What do you think is going to happen?
So everybody sounded really pessimistic, but obviously we have only had about 17 to 18% reports yet. So far, actually, the numbers have been better than expected. I think that is meaningful, that we have been able to pass the very low bar. And as we all know, earnings expectations had been revised down pretty significantly from June of last year to now. And I think going forward, what we're looking for is, to your point, what is going to happen with pricing? How are companies able to preserve their margins? How are people talking about their actual right sizing? How are people actually able to look at growth in earnings and growth in the U.S. economy in the months and quarters ahead? And we think that in this juncture, looking at companies that have quality associated with them, so really the ability to preserve margin. So growth, yes, but growth at a reasonable price. We think that really makes sense. And that, sort of looks at tech, but also surprisingly things like energy companies.
Yeah. Gargi, what you're describing, though, is a market that is going to, you have to move quickly in order to take advantage of the opportunities. as you say, 4 regimes since the beginning of the year. Why do I want to put money to work in these markets when I can sit back and take a decent interest rate in cash? Do you expect this continuing regime change story to carry on for the rest of the year? And if so, what do I do with that if I have a longer than 4-week time horizon?
Listen, we think investors should always be invested and think about that long-term horizon as their North Star. So certainly these are times when you can and should be more nimble, but you shouldn't be out of the market altogether. Now, Can you be in cash? Absolutely. Looking at things like SGOV, which looks at, which basically is holding in the very front end of the Treasury curve, we've seen tremendous amount of inflows into that particular iShares ETF. And I think that continues given the yield environment that you pointed out, Guy. But at the same time, again, the risk reward of owning fixed income right now, front-end fixed income, higher quality front-end fixed income, but at the same time waiting for about a 370 or so to just get back into duration. We think that makes a lot of sense, and it could be a generational opportunity to clip coupon at close to 4% in an area of the market that has a lot of safety associated with it.
So to that point, we were talking in our earlier segment, and we brought up the sort of Fed rate cuts, that if that is priced out, that becomes the real catalyst for everything to shake out. If that's the case, how do you hedge that particular risk while taking into account the fact that we may not trade there for a while, or it's going to take a while to get there?
Yeah, I think that, right now, as I look at what's perhaps a little bit mispriced in the front end, expecting a rate cut by the end of this year does feel pretty extreme, especially given that we know that core PCE by the end of this week is probably going to be meaningfully above 4%, so somewhere around 4.5%, 4.6%. And we saw the same with CPI, which at least the services part of CPI remains very sticky. So to expect the Fed to cut this year is going to be very tough. But I do think what we're going to focus on for the next 2 or 3 months, perhaps, is the pause dynamic. The Fed is going to signal a pause. They are eventually, at least perhaps after this meeting or certainly after the June meeting, going to pause and then stay at that higher for longer level for some period of time. Maybe that's 6 months, maybe that's 10 months. Historically, we've seen that the Fed has paused for about 10 months if we look back up till the 90s. That could be the case. It could be a little bit shorter. And within that pause period, what happens? Well, what we've seen happens is actually the front end as well as overall high quality fixed income, such as the ag, does very, very well in these pause periods. So the narrative shifts from the cuts, which is where we've been grappling with, to the pause. And I think we're going to see that probably as soon as May.
Gargi, if I'm buying the pause, am I selling the tech?
If you're buying the pause, you're certainly buying the ability for fixed income to do really well in that pause environment. I think that's what you're doing when you're buying the pause.
But if rates are going to stay higher for longer, and the duration trade, the long duration trade has been tech traditionally, and it seems that's how the market has been treating it, do I sell tech on the back of that? Tech has last week it didn't maybe, but tech has outperformed very strongly over the last few weeks. Does that continue if the market now buys this idea that the Fed is going to pause?
Sure, Guy. I think we have to make a differentiation between tech that is actually able to be profitable versus the non-profitable parts of tech. And I think that's really different in the cycle because we are not going back to a negative real rate regime anytime soon. So historically, what we saw post-pandemic was the non-profitable tech do very, very well in a negative real rate regime. We're not getting back there. So tech, where you have positive cash flow, tech, where you actually have a huge amount of profitability and margin stability, absolutely, you're supposed to own that. Tech, which is unprofitable in a positive real rate environment, doesn't do well. So there are different types of techs, and we have to be very careful about navigating those.
Gargi, it's always great to see you on set. Thank you very much indeed for coming in and seeing us. Gargi Chowdhury, BlackRock Head of iShares Investment Strategy Americas. Thank you very much indeed. We're going to stick with tech next. Tesla raising its forecast for CapEx. Again, this is it cuts prices. The electric car maker now expecting to spend up to $9 billion this year. The details are to follow. The startup is next. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Angel Feliciano. Disney began its second round of job cuts today. That's part of its push to eliminate about 7,000 jobs this year. The company says that by Thursday, around 4,000 jobs will have been cut. The cuts stretch from Disney's headquarters in Burbank, California, to the ESPN sports networks in Connecticut. It's the end of the line for Bed Bath & Beyond. The home goods chain will close all of its stores and liquidate inventory over the next 2 months. A turnaround attempt failed, leading the company to file for bankruptcy protection. Bed Bath & Beyond employs about 14,000 people in the U.S. and Puerto Rico. And Coca-Cola posted first revenue growth that beat estimates. Consumers were willing to pay higher prices for Coke's sodas, juices, and energy drinks. In North America, the average price across a mix of products grew by 11%. And that's your Bloomberg Business Flash. Alex?
All right, thanks so much, Angel. It is 20 past 7 on the West Coast. Want to get to the startup where we cover the top tech stories from the Bay Area and beyond. Ooh, beautiful morning. Silicon Valley just waking up. Joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, a pleasure. The news, Tesla raising its CapEx this year on the high end. We're looking at $9 billion for 2023. Right. That seemed to surprise the market a bit.
Yeah, I mean, in pre-market trading, the shares fell pretty sharply in response, and that didn't last very long. You know, it continues a trend for Tesla in adjusting and pushing CapEx higher, so $7 billion on the low end of the range, $9 billion on the high end of the range for 23, but it's a $1 billion boost, essentially. And it goes back to this idea that while the company's cutting prices on its vehicles, you know, Elon Musk and Tesla are kind of committed to growth or maintaining rates of growth, including investing for that growth, even if that comes at to the detriment of the bottom line.
Ed, does this mean that Tesla is no longer a luxury car maker in the way that it once was? It's going for volume, it's investing heavily in capacity, and it's cutting prices.
Yeah, I think what's really interesting is that if you are a Tesla